Welcome to the inaugural Full FX conversation with me, Colin Lambert of the Full FX. Some of you may have read the report we put out last week on the grey costs of FX. It was published by the ValueExchange and HD Financial Consulting. It was sponsored by National Australia Bank and Lumint, and it was supported by New Change FX and ACI, the Financial Market Association. Me being me, I thought it'd be a good idea to get some of the stakeholders around what would be a table. I'm sorry it's not a table, and it would be a great table, but even perhaps with a glass of wine. I'll whisper that one. But I thought it'd be a great idea to get the stakeholders around to have a chat about what we thought about this report and what it told us, because to me, the grey cost of FX was a very good report and highlighted what could be some important lessons for several parts of our industry, not just maybe the asset managers that it would be the headline effect. So joining me, and I hope that actually it's the same order. I'll go from top left. Barnaby Nelson is CEO of the ValueExchange. Xavier Porterfield is Head of Research at New Change FX, middle left. Katie Renouf is Director FX and Currency Overlay Sales at National Australia Bank. Alex Dunegan is CEO of Lumint Corp, and Matthieu Herbeau. Always
just about right. Thanks.
Just about right. I'm sorry about that, Matthieu. Matthieu Herbeau is
you're not the first one to struggle with that.
CEO of HD Financial Consulting. Katie, I'll start with you if I may, because I thought it'd be a good starting point. Let's get people's key takeaways from this report. What did the report tell you?
Colin, so I think for me personally, we'll start with the headline figure that came out of this. So the 39% of clients not tracking TCA for their FX and what that means. Because I think, I spoke to this to my colleagues about this, and they said, well, some of those clients that responded, they might only be trading spot, or they might not be captured by regulation due to the various refits of EMIR, etc. And I thought, well, that is a good point, but actually it's still incredibly important to track these costs, because if you don't have a handle on these costs and you're making all these operational efficiencies and you're investing money into technology to make improvements, how do you really know where you want to save money? So I think that was like the real headline thing that came out of the data for me rather. And the other big one that sprung out that links into that quite nicely is the fact that less than half of clients were factoring FTE as a cost for their FX. So that's a cost which is a market one, it's only set to rise. The cost of staff in central London in particular is not going down anytime soon. So I think that's something that clients really should be taking a closer look at. I've got a few other comments, but perhaps I'll pause there to allow people to add something.
On that point, Xavier, I mean, it's interesting, Katie says, some of her colleagues might say, yeah, they're only doing spot. The odd half a tick on half a yard kind of adds up, doesn't it?
It really does. It really does. But it's also, for me, that's what really sort of made it, brought it home, this message of how, why are these costs grey? And they're grey because we're not looking there. And the whole exercise was to bring our attention to what's going on in this space. And what I really liked about the report was how detailed it was and the ground that it covered, how comprehensive. So yes, there are implementation costs. Then there are all these other costs as well. So then you've got to decide, where do we focus? What's the most important place for us to focus? And I think something like this can really help people with that.
Yeah. Alex, from your point of view?
Yeah, I think so too. I mean, I think that was the nicest thing, I think, for me to see in more black and white, right? To clarify it a little bit, those extra costs beyond what the spread is, and how much those can add up, particularly for a smaller team or a smaller business, or even a medium-sized one, where that overhead to get those more fixed costs beyond just spread can have a huge impact on their business and their returns.
Yeah, and Barney, it struck me that the report actually covered a broad range of sizes when it comes to the funds as well. From your point of view, obviously you've lived and breathed this report. What would you point out from it?
Yeah, I think for me, I think the most alarming thing was just how coming in as a kind of slight generalist against this, the experts in the room here. For me, one of the things that really stood out was how badly we're managing FX versus other asset classes. In terms of our overall management of costs, we're way short on FX versus other asset classes like equities, fixed income, in terms of just tracking the deeper costs. And to your point, I think if you look at the AUM spectrum, we seem to we seem to have a lot of different problems at all the different levels of the journey. You know, you've got a question mark about basically, you know, whether bigger funds are actually really leveraging their AUM and their buying power just to drive down costs, or whether they're actually getting better at their FX as they grow, or potentially actually worse. So for me, there's a big oversight question, and then there's a question of kind of diseconomies of scale reacting to the report as well.
Yeah, and Matthieu, I mean, it's one of those. I kind of look at it and think to myself, I hope that people sit up and pay attention to this, you know, from those sort of disconnects.
You're right, and that struck me as well, because I think well, you and I have been looking into FX for quite some time, and also those hidden costs. And it's not the first report that comes out that highlights the lack of tracking and the lack of understanding of what the costs are. But it just goes to show that even, you know, a year ago, I think Newton and Lumint, you collaborated on cost as well, on share class hedging. And you would have thought that there is growing awareness around that, but in fact, it doesn't seem that this way, and that FX costs just seem to go under the carpet, right? So either there is a lack of understanding and lack of awareness. Is it a deliberate will not to look into that? I don't think so, but it's just a question of understanding something that is not the core business of the asset management and the fund management space. Asset owners, and we saw a real disconnect between asset owners, fund managers, and banks. I think asset owners need more education around that to understand that ultimately, as well as for the asset managers, it's going to be a drag on performance. And there is a clear benefit at understanding those costs and managing those costs to enhance the yield, as we know it's difficult today to generate yield. So we want, with that survey, to bring once again awareness to the market around grey costs, understanding them and managing them.
I mean, Alex, is it a question of, like, to use what my old Labrador used to do, just bang his head against the door until it opens?
Well, you know, coming from a fairly new company, there's I can empathize with your talk. Yeah, sometimes yes. I mean, some of these things, right? We know, we've seen and talked about in FX for a long time, right? Measurement, clarity, timestamps, you know, the availability of data. I think one of the interesting points, though, you just mentioned, Matt, and as well as from the survey, is the disconnect between the different industry groups. So, you know, it seemed fairly well aligned between fund managers and banks, but a little bit of a disconnect from the you know, the asset owner side. I think that goes into exactly what we were just talking about of there being, in terms of order of priorities, right? Fund managers and banks are going to be more focused on this as a business, have probably more responsibility and accountability for their bottom lines compared to an asset owner, which maybe is overworked and understaffed. Certainly that's the case in North America, but also, you know, one that has a lot of other things that are higher priority in terms of achieving returns and things like that before they get down to that question of FX.
This disconnect question, Xav, is quite an interesting one, isn't it? Because I mean, ultimately, you're talking to, yeah, there's a chain of command, isn't there? And there seems to be, yeah, not many things work well when the chain of command's broken.
Yeah, but also I think we work in such a conservative, naturally conservative industry. You know, because it's, you know, we're managing people's money, and so being conservative is kind of considered to be a good thing. But when, you know, so we've been living in this incredible technological boom for the last sort of 20, 30 years, and it's and what this report for me was showing was that people are still not implementing some of the technological gains that were discovered 30 years ago. What's going on with that? Why is that? There's, you know, this could be a fascinating case study for behavioral analysis.
It could very much be that, you know, this is one of those things where, you know, everyone does nothing, and then all of a sudden everything happens at once, and everyone goes like, "Why didn't we do that 20 years ago?" Yeah. I mean, you do sometimes think that. I mean, Katie, from your point of view, I mean, as a service provider, what do you think the key things that you know people need to look at from this report?
So it's an interesting one for me, and I was actually about to add this comment. So when you think about the obvious costs that are out there, so FX margin and settlement costs, coming at this from a bank perspective, you know, clients expect us to have vested interest in this. You know, this is where we make our money, right? But over the last few years, those two components have been so heavily squeezed, there's actually very little room left to go on that. So this is where, you hear the word sort of partnership approach thrown around in the market, but I think that's really what, we're trying to do here, trying to partner with our clients to help them find other opportunities to generate value or to create efficiencies in their models. So looking at things like FTE, for example, which obviously was one of the major cost components after the margin and the settlement costs, how can we support our clients there? Looking at their efficiencies, we know there are still clients out there that run their hedging programs from spreadsheets. So could we potentially step into that process, de-risk it in the meantime, and help strip out some FTE allocation for them? So not necessarily, this doesn't always mean getting rid of people. This just means putting time back into your core activities. If you're a portfolio manager, if you're an analyst, putting your time back into alpha generating activities. So I think that's where we can add a lot of value. And then there's obviously the other components that are in there, things like liquidity. So, for me, a lot of our clients, the way they trade their hedging, it's not always in a manner that optimizes liquidity. So sometimes you've got lags throughout the day, or if you trade all of your rollovers at, say, month end or quarter end, is that the optimal model for you? So looking at things like that is how we're hoping to deliver some value back to our clients.
And Xavier, there's a wealth of data out there now, isn't there, to support that sort of process that Katie is talking about?
Absolutely. I mean, that's one of the things that we were doing at New Change a few years back, was some of this, hedging optimization of when should you roll, and looking at the data. So the data is around. How do you bring it in? How do you use it? How do you allocate the time to actually do the work, to actually then determine and to use what's available?
Yeah.
I'll add to that too. Katie and Zav, I think you're exactly right in terms of service provider and things like that. But I think your 2 points are related in terms of the technological change. I think most firms, particularly maybe because most financial firms are conservative to as an industry, that it's harder or there's more inertia to technological change and overhauling processes and systems than there otherwise would be. And not to mention there's a cost to it, whether it's time and money or complexity. But I think that's where, Katie, your point comes in really well, is right, that as a provider you can already harness those economies of scale, and then it can be a pay-as-you-go model for those clients to come in and enjoy the benefits there without having to spin it all up on themselves and bear the full brunt of the cost.
And it's an interesting one, isn't it? Because you kind of look at it and think to yourself, well, the answers are there. Why aren't we using it? The technological change, but I guess we do have to take into account, in the defense of these firms, that the last 18 months have been very risk averse for the whole world.
Yes.
Are we actually looking at a situation whereby maybe the sort of shackles will be taken off now that we seem to be coming out into a new normal, whatever that may be? Do you expect there to be sort of more movement on this general issue of adopting technology?
If I may answer perhaps, I think so, yeah. So particularly at the start of the COVID period, if you like, so March last year, I think from then, probably for about 6 months, achieving BAU was something of an achievement. Yeah. And a lot of fund launches were delayed. Obviously investors were a little bit wary, so they were holding onto their money. There's a lot of dry powder in the market. But I think clients have learned a lot from that period, particularly the sort of dislocation that we saw sort of Q1 last year, where perhaps they're managing their own rollovers. They struggled to find good liquidity or good spreads. So I think that has now made them perhaps more inclined to look at outsourced solutions. So we've certainly seen a lot of interest in the last 3 to 6 months. And you see that clients, a huge proportion of the respondents to the survey are looking at making technology developments into next year. So I think coupled with that, it's a really important time for us to be doing this, because depending on what those technology investments are planning to look at, they might be looking at the wrong things, like the wrong cost saving basis. So I think this is a perfect time for us to be helping them.
And Barney, I mean, one of my key takeaways was actually this whole outsourcing piece. What did the survey say?
Well, I think for me, there's 2 pieces to it, really. I think one of the real causes for concern is that we talk about the solution as being blindingly obvious, but I think part of the challenge is that actually the stats that show that none of us can agree on what the cost of an FX trade is. You know, depending on where we sit in the organization, where we sit in the investment cycle, in the pecking order, you know, we're all at odds and evens. I think in terms of actually how we define the cost of our last trade or our next trade. And as a result, we're all looking at it from slightly different angles in terms of where we can make savings. Because if we don't agree on what the ingredients list looks like, then basically we all risk kind of pointing our guns in the wrong direction in terms of what we're trying to fix. So I think for me, there's quite a lot of cause for concern there in terms of just the disparity of views around how the cost of a trade are actually made up. But to your point though, on the outsourcing piece, you know, I think what's really interesting is that it's, you know, first of all, you've got more than 65% of investors who are looking at outsourcing execution in the next year. So that's great. You know, people starting to, you know, I think to Katie's point, starting to realize that there is more there. But I think what's interesting is that there are actually more banks looking at outsourcing their execution than there are investors. And so there is seemingly a real move towards outsourcing across the board. And it's not just outsourcing the kind of the boring functions. It's not just the, you know, the trade booking and the settlements and all that kind of stuff. It's actually, you know, I think 30% of people are actually outsourcing their core execution capabilities right now. So it's all moving in that direction. I think, as Katie says, you know, that we seem to be kind of locked and loaded for a good run from here. Lots of intent. But I think for me, the key thing is that it all starts with an education process, that we've got to be looking for the right savings in order to understand the benefits of outsourcing, because if we go in with the wrong view, we'll come out with the wrong ROI and probably underestimate the value of what we've just done.
Yeah, I mean, Matthieu, so this basically says that we, to use another analogy, and I'm sure I'm mixing my metaphors all over the place tonight, but this means we've got to pick our battles when it comes to like discussing this with the clients.
No, you're right. I think I'll just go back to what Barney was just saying around the outsourcing of the numbers around outsourcing. So it's true that the boring functions, as you mentioned them, which are core, don't get me wrong, have already been outsourced in the past. I think it all started about 30 years ago with the outsourcing of the back office functions, middle office functions. But to your point, people are more and more looking at execution because either you're really good at it, or but if you're not that good at it, the value that you can get, and I'll go back to one of Katie's points, is that you're going to be struggling more and more now to squeeze more on the spread, to squeeze more on the settlement cost. So the value that a trading desk within an asset management firm, let's say of a medium size, could bring is going to be less and less valuable. So it will make more and more sense to outsource. Because your provider out there, your FX provider, can take care of the regulatory cost of the regulatory reporting. You know, they've got the human resources in-house, they've got the premises, and all those costs are the ones that will be growing. That's what the survey shows. Over the next few years, premises costs, regulatory costs, HR costs are going to be growing, whereas there will be a limited room to reduce the spread cost and the trading cost. So there was a strong call for outsourcing, I think, in the result of the survey. That's one point. And then I'll go back to a few other things that have been said around the FX market. You know, COVID or no COVID, the FX market keeps growing. It's still the biggest market in the world. I think we're above $7 trillion a day now. The last numbers from the BIS, but in 2019 were 6.5 trillion. So yes, there was COVID, but the markets have kept functioning. And it's such a fragmented market that it becomes difficult to be good at it if you're not a specialist. And that's, again, calls for specialist providers. We have specialist providers in the TCA space, we have specialist providers in the hedging space, and we have strong banks that can offer outsourcing services as well, partnering with their clients when it comes to hedging, whether it's share class hedging, which is a very passive activity and generally bearing a lot of risks, whether it's asset hedging or just even the pure day-to-day execution. I think it really makes sense to question the existing models.
I mean, it's not exactly pulling the pin out of the hand grenade and throwing it in, but if I may just sort of put one observation out there, what we're talking about with outsourcing, generally speaking, is a fee-based business. And a lot of providers that I talk to all have the same, I wouldn't call it paranoia, but should we say fear, that whenever you get into a fee business, fees get crushed through competition. And very quickly, you go into a great business, which is outsourcing this, and all of a sudden it's like, hang on, I've got to do this at 50 cents a million or whatever. Is there a fear that, is this why maybe it hasn't worked in the past? Because fees get crushed.
So I'll take the counterpoint there. I think part of the way that equation works, or I think the way that model would work for people, is if you can keep up with the technology side of things, right?
Yeah.
Which I think some of the traditional institutions have had rising costs there, and it's harder for them to, for instance, maybe it's harder for an institution to move to the cloud, or a slower process and more expensive for them to do so, to realize those cost savings to keep up with the march downward in fee-based prices. So I think it's a little bit of a catch-22, right? If someone can pay, or if a client's willing to pay, and an institution's willing to accept those low fees, that means there's somewhere someone's doing it with the proper margins to pursue the business, and maybe the competition just can't keep up. I think it would otherwise have petered out, and there'd been a lot more insourcing and those kind of things if there wasn't a solution out there that could sustain those lower levels of prices.
Do you think outsourcing is actually likely to be a sustained trend?
I think so, and I think to go back to Katie's point, and then the general point about COVID times, right? I think that's forced so many institutions that were otherwise conservative to make pretty very quick and very dramatic changes to how they deal with things in terms of technology at an HR or a general collaboration level. I know there was a large public money manager that rolled out 2,000 licenses of Slack in like a week, right? Because everybody needed to adapt quickly, and I think that ethos, or that habit, has started to spread to all parts of the business, and I think that's partly examining things like, are we really adding value here? Does this really help us from a bottom line, or a top line perspective, and are we better suited to outsource? So I think that trend will continue. We're seeing it up and down the scale, right? We're talking about FX here, but there's so many new offerings in terms of kind of full outsourcing. You can be one person with an idea, and you can start a full fund, and you don't have to touch a Bloomberg keyboard to execute any trade or send any reports out. And I think that will continue to go, as I think all the full technological landscape allows for those kind of things to be a purely pay-as-you-go basis.
I think as well, I'd probably just add in, for me, that there's another question here, which is, what else are you going to do? I think for me, outsourcing is basically an option. It's one of the things on the list of to-dos, or possible to-dos. I think for me, when we ran through the research, you can see that there's significantly diminishing returns on some of the obvious things about insourcing or offshoring, or basically, or trying to beat up your broker with better fees, or even consolidating down counterparties. All of those, you can see that the economies are really, really thinning out from those. So looking ahead, if not outsource, then at least from a survey perspective, I mean, you're really then looking at basically taking on the system load in-house, and to Alex's point, taking on that kind of arms race responsibility in your shop rather than outside, to keep up with technological curve, or basically either that, or it's kind of basically peer-to-peer execution, and basically robotics and things like that, which are kind of, I'd argue, valuable, but slightly more niche.
And one thing I would say, Katie, is that underpinning all this, what kind of role does a relationship have? I mean, it strikes me it would still be very vitally important, but we talk so much about technology that sometimes the relationship aspect of our business can get lost.
I agree. I think you can have the hybrid approach, right? It's the best of both worlds. And I think we've almost gone 360. So, in the time I've been in the market, it's gone increasingly electronic, it's gone onto e-platforms. But I think there's always going to be the value of having that trusted salesperson, because you might have the kind of BAU flow. So to me, if clients want a pure outsource, which is kind of a lock up and leave, they get a report to show it's been done in accordance with the terms, that is appealing up to a certain size or for certain flows. But I think when clients are doing things like portfolio transitions, or when they're maybe moving into EM or things like that, I think there's always value to having that salesperson either on IB or on the phone. And we've found that particularly through COVID, particularly, started last year, our clients were speaking to us more than ever. So I think there will always be a role for that relationship.
Yeah. I guess what I wanted to close out, and Zav, I'll come to you on this one if I may. I mean, how do you see the buy side engaging with the FX market in the coming years? We've spoken to a degree about how not a lot has changed. The survey is kind of indicating there's this willingness to embrace at least a discussion around change. How do you see this evolving from here?
So, I touched on earlier this idea about an adoption cycle, that we're quite a conservative industry. And yet, as I was reviewing a while back, a few months ago, how many new initiatives have come in and have gone live in the last 18 months, which offer something new, something different, which in terms of implementation. So, we mentioned peer-to-peer. That's a real proposition now, which didn't exist maybe 2 years ago. So we're still in that sort of innovators and early adopters phase. So what is what will be the driver that drives mass adoption? And that's a slow process. So things exist now. So over the next, and that sort of drive towards mass adoption is, I think, what's happening.
Yeah. What role do you think? I mean, do you think that data will play an even bigger role in driving this process forward? Because I think it helps anyone's argument if you've got some hard data, doesn't it?
Well, it does. Yeah. So if you think about it, so we have technology, and out of that technology we have data. It's now like a new kind of religion. So with that data, the data is only as good as how you use it, and also, obviously, whether the data that you're collecting is actually useful for what you want it to tell you.
Yeah. Alex, do you think there's a question here as well that, we've mentioned also there has been this leap forward in technology, to Zav's point, over the last 18 months. Do you think actually there's also a degree of people kind of wanting to make sure they pick a winner? Because if you go back 20 years in the FX multi-dealer platform, there was a stark choice, and some are still, I think, smarting from backing the wrong horse.
No, you're absolutely right. I mean, even for things that it's a small part of the process, or it might be a small part of a client's business and incidental to their business, right? Not even a primary driver. You think that would be a quick and easy solution, but what we see is that still takes maybe a year to two to implement. A transition to a new platform like ours or someone else's, and it's those kinds of timelines and the lift that's required that I think does make people want to make sure they choose a winner, right? And in that case, it's not necessarily that the service may be better or another, but there's certainly some career risk there for that individual or that decision maker at a firm that has to, stake their reputation and put their own time and resources into, bringing someone new in, despite what the results may be. So, I think that's absolutely right. I think there's along the same lines, right? In outsourcing and things like that, you want to achieve the economies of scale that helps on the price pressure you were talking about before from a provider standpoint. And there's my old boss Mark Christman used to say, you never want to be wrong and alone, right? Now, if you're wrong and together, it's fine. So there's certainly a herd mentality there that comes into play.
Yeah, as an old cable trader, I can say I was used to being wrong as a herd.
Yeah.
Matthieu, how do you see the sort of buy-side engagement with the FX market changing, if indeed it does?
What I really hope for is for more discussion and education. I mentioned that I think at a starting point, but I am an example of that, but there are many others in the market of people who have worked in the FX market, in the custody FX, who are have decided to go independent, and we're here to help. We're here to assess, provide guidance. I know the players in the market. I know the banks that offer outsourcing services. I know the independent firms that will offer outsourcing services. I know the TCAs in the place, and we're really here to make good introduction, good connection for the benefit of everybody. At the end of the day, it's your pensiony money who is being managed by the fund managers and the asset managers. So you have a genuine interest that everybody wins in that market. So there is still room for fees and money to be made by the banks and the providers, but there is room for improvement. There are plenty, to Xavier's point, there's been plenty of innovation over the last few years, peer-to-peer, benchmarks. Colin, I know you're very fond of well, you're not fond of the 4 p.m., and you regularly talk about alternatives to the 4 p.m. So I think that will grow. And one aspect of the survey that struck me as well was, I think education is getting there. The fact that the market impact was one key component picked up by the people we surveyed as a cost of FX makes us realize that there is growing awareness of what happens when an FX trade is being done. And there are alternatives, once again, like peer-to-peer to minimize that. But, I think we all need to get together in that ecosystem and make it work better. I think it's an effective market, it's an efficient market, but it has room for improvement. And I think it's the collaboration between buy-side firm, the engagement of buy-side firm with the providers out there that will make it better for everybody, including us at the end of the day when we retire in 20 or 30 years' time, because we're still very young and very fond of what we're doing.
Nearly. I suppose I should probably set the record straight. I don't have a problem with the 4 p.m. picks per se. I have a problem with the fact it's only 5 minutes long, which
Yes.
I think is where I'll go. Katie, from your point of view then, do you expect to see your engagement with clients changing over the coming years? And in sort of what sort of way would you expect it if you do?
I think we will, yeah. I think we're going to see an increase in what we call like the consultative style of approach. So when we go and see our clients now, they're very open with us about, you are here on our liquidity panel, this is the spreads we're seeing elsewhere. And I think we're already moving into new territory in terms of the openness of the conversations that we're having. So I think that's going to increase. And I think particularly that we're going to see fragmented sort of share class hedging and portfolio hedging processes, in my view. Portfolio hedging will remain with the PMs, I believe, where there's active strategies around that. Share class hedging, perhaps, where there's less alpha scope. I think we'll see an increase towards outsourcing on that. But definitely more open and honest conversations is the way forward for us.
And it strikes me that managers are definitely starting to look at different styles of execution for different types of trades. Is that something you're seeing?
Absolutely. So we have FX hedge pools, so the peer-to-peer matching. There's other guys out there that do that. I think that is a natural place to look, particularly in those large recurring volumes that you might see in things like share class hedging. Use of algorithms, how you introduce that into your volumes, increased transparency around EM. I think all of those factors play a really important part in the next couple of years.
Yeah. The algos is an interesting one for me, Alex, because there seems to be a bit of a divide. I'm not sure if you've got any sort of window on this, but there seems to be a divide, definitely a growing body in favor of using algos. But there are still managers I talk to go like, no, I'm not going to use those. I'm still better than the algo.
Yeah, we see that similar type of split too, and talking to clients and prospects. I think they all have their place, right? I think to Katie's point, I think the way we look at it is you want to split up your type of execution tailored to the type of trade you're doing, what the objective is. Am I an alpha FX trader and trying to squeeze some returns, or am I fulfilling some passive hedging obligations? Even within accounts, so, we treat it differently, where if it's a share class hedging account mandate and there's flows coming into it, the benchmark's the right place to be, because tracking errors, minimization is the objective. Whereas an algo or trading directly may be better in maybe an EM currency versus an algo on a euro trade or a cable trade. So I think taking a tailored approach, and I think going back to technology and relationship and the economies of scale the provider can access, I think that's where it becomes interesting, because then you can really go to a client and say, what is your exact objective across all the different types of FX activity you do? and we have the right solution for you, right? That's what you want to be able to say as a provider, to take that tailored approach and you're most likely use technology to do it, and do it in a cost-effective way.
Yeah, and that's really where data comes in, right?
Yeah.
In those decisions, what should you expect, given what the market's doing? Should you trade straight away or should you trade in algo? How do you make that decision? You can only make that decision with good data.
And I guess the other point, Zav, is that generally speaking, the type of business that these customers are doing is fairly steady. So previous trading data actually is a fairly decent indication into how the market and their order would interact going forward.
Sure.
Yeah.
I think there's another point here that's just it only just occurred to me, but to the point of Xavier's, the adoption curve, it's also worth bearing in mind that these fund managers, especially, they're very comfortable now with the outsourcing conversation. I mean, if you look at how many fund managers have outsourced other parts of their pretty much all of their back office operations, their bookkeeping, all that kind of stuff. I think that's the kind of precursor to outsourcing any specific functions, is just the ability to have an intelligent conversation around that, as Katie was saying, and as Alex as well. It's different pieces fit different things. It's not just okay, here you go, take it. It's okay, how do I shape my outsourcing to suit me? And I think, for me, what's really encouraging is that fund managers, generally speaking, with the huge amounts of back office outsourcing that's going on, they're comfortable having a conversation around pros and cons, business case, all that kind of stuff that's much more nuanced than it used to be. And so therefore, a lot of the benefits we're talking about, I think, will be more easy to kind of discuss and negotiate.
I wonder whether the challenges, though, for outsourcing is the fact that outsourcing crystallizes a cost, whereas
Yes.
in this survey, 39% clearly believe that FX must be free, right? Yeah.
But it's the oldest thing, isn't it? That normally when you go to somebody and you say, I'm going to outsource, you say, well, I reckon I can save you $2 million, and they say, well, I think you can probably save me about $20,000-$30,000 tops, because again, if you're looking at the wrong business case, you're going to get the wrong number. And so you're absolutely right. Suddenly you're wearing a cost of $2 million that you thought is thousands of percent more than you were paying before. Actually, your quid's in, but you just your accounting doesn't show that.
I mean, that's what I'm kind of excited about, and looking forward with the results of the survey, because it's a nice, look back at and looking at the breakdown of costs. But I think it can also be used as a proactive tool for clients to start to tabulate those costs for themselves, right? And for providers to help them tabulate. And it'll be different ratios there, but to be able to put something, a number on all those buckets, I think will help answer those kind of questions. Whereas before, either they're, the head's in the sand, or the information is just not there, the data's not there to use.
Well, that could be a conversation for another time, whether the heads are in the sand or not, because I think then we would definitely get into some controversial territory. Sadly, we haven't got time for that one. But Katie, Matthieu, Alex, Xavier, Barney, thank you very much for your time today. Fascinating discussion. We could go on. We may even think about revisiting this, I think, maybe in a few months' time, see how things have actually changed, if they have at all. But in the meantime, thanks very much for your time today. And thanks everyone for watching. And we'll be back again soon. Thanks a lot.
Thank you, Colin. Thank you all.
Thank you.